Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and joined by the jet setting.
I'm back, Bills.
Jet setter.
Yes, Andrew back again for another episode of the 360 Money Matters podcast.
Andrew is nice and tanned as well too.
Yeah, so for those that are viewing, I get to show off my tan for a little bit, but for those that are just on audio, you're just going to have to take our word for it.
I'm very jealous. I must say, I'm very jealous. You do look like you've been basking in the Mediterranean sun.
Well, with how cold it is in Melbourne, I feel like this is going to be gone in a couple of days. But yes, I'd like to say that it's good to be back, Bills, but I'd certainly be lying.
Well, it's good to be back on the podcast, right? So that's probably the thing that you missed.
Yeah, exactly sure. Right, exactly right. I missed everything, It's good to be back. It's good to be back. Yeah.
So assuming it was a great holiday?
Oh, of course.
Yep.
How is it not? Greek islands, summer weather. Yeah, nothing that you can say bad about that. But we're back, and we're back with another episode.
This is true. What are we talking to everybody about today?
Well, I figured that since I'm, just come back from holidays, that you're going to do all the talking. I'm just going to sit back and ease my way into it.
Well, our listeners and our subscribers have gone up, so you've got to keep that momentum because everybody saw Pat and heard Pat, and now they're waiting for some, the big shoes to fill.
I think Pat's somewhere in the background. I can go grab him and bring him back in if that's what everyone wants to listen to.
That's it. All right, so today, market wrap.
Yes. So back with another market wrap.
Yep.
Giving a bit of an update as to what's been happening in financial markets, where things are at, and what's been happening both in Australia and across the globe.
Great. Let's kick it off. I guess we start with the US because they seem to always lead the charge. But what are we looking at from the US's perspective?
Yeah. So look, we've seen some mixed data coming out of the US. There's evidence of a slowing economy, but the job market is still strong. It's seeing a fall. So job market over in the States is seeing a bit of a fall in terms of the unemployment rate, but it's still actually quite strong, which is starting to shift some of the perspective of economists. So more economists now are starting to, and investors, they're starting to increase expectations of a soft landing. We've been hearing this story of a soft landing everywhere, both in Australia, both internationally. But investors are having a little bit more confidence that we might be able to, pull through some of this high inflationary environment without actually needing to, crash an economy.
So basically avoiding a recession?
Exactly right. And that's not to say that, economists are all saying that, we are going to avoid a recession. What it is saying is that more economists are now starting to, shift onto the perspective that we might be able to do so.
Yeah, it's a really interesting one, the phrase around soft landing. I always think about an aeroplane. Exactly. And now just hearing you say it, I'm going on an aeroplane next weekend. So I'm like, I don't like using that analogy anymore. Maybe we should pick something different that's not an aeroplane, right? I don't know. But yeah, no, it is interesting. Although in saying that, it sounds like with that mixed data, that was the intention in terms of making the economy to slow down. That's always the intention of increasing interest rates, and I guess the mechanism that sits behind it is if interest rates are higher, there's less disposable and discretionary income in people's pockets, so they've got less to spend, which means that on the other side, if you're selling goods and services, there's less to receive, so things slow down.
Yeah, but normally what you'd expect with that is you're receiving less, and so businesses start to lay people off, and so unemployment starts to kick up a little bit, which we did see some commentary from the RBA governor.
Yep.
Talking about this specifically.
Mm-hmm.
But what we are seeing over in the States is still a strong job market. So it does mean that you're able. it's a very fine tightrope to walk. But if you can slow down the economy and people can still be employed, businesses can still afford to employ them despite the fact that there's, you know, a slowing down economy, that's nirvana, right? Like, that's keeping the economy going, not crashing the economy while slowing everything down. But it is a very fine tightrope to walk, and so that's why there's this, you know, commentary on, are we going to go, you know, a soft landing, or is it going to be a hard one?
Well, it's interesting. I mean, in saying that, because based on what we've been seeing, it looks like we're getting close to that point in time. I mean, that's definitely the case in Australia. But the expectation, at least in the US, is that rates are still going to rise.
Yeah.
So they feel that, in terms of the commentary that's coming out, they feel that they're not there yet. But it's interesting because you've got this kind of mixed data at the moment where it potentially is at that turning point. And I guess you always reach that and go through it. It sounds like we're very close, but we're not there yet. If the rate rises, if the commentary around the rate rises is still that, hey, we need to continue, I think we're getting close, but I don't think we're there yet.
And the fear from investors is if reserve banks push rates high or too high too quickly, then the flip side of it is that an economy crashes and you see things like recessions and all of that happening. The hard part of it is you increase rates today and it's not going to have a flow-on effect for 6 to 12 months later. So you don't actually know whether, you know, with an exact science, the rate rises that you're doing today, whether you've actually managed to achieve what you've wanted, and you're not going to know for a number of months later. Which is why, you know, you are seeing some reserve banks around the world pausing rate rises, waiting to see how things come and flow through in the economy before they, you know, push things too far.
Yeah, and we've spoken about the lag effect before.
Yeah.
So it does make the job of, you know, the central banks more and more difficult, because trying to make a decision on what's going to happen in 6 to 12 months' time, based on what you've done today with interest rates, is difficult. So yeah, I don't envy the position that they find themselves in. It's a very difficult job, and the consequences are extremely high. But yeah, that's why they get paid the big bucks, I guess.
Yeah, exactly right.
The S&P 500 for the month of June?
Yes, up 3.8% up in the month of June. So we're talking about the largest 500 companies, and that obviously has a very strong rate weighting towards the US. Was up in the month of June, which good news for investors.
Yeah, I mean, look, on an annualized basis, and you can't take 1 month's worth of data and multiply it by 12, but 3.8% for 1 month is really significant.
Massive.
And it's interesting, considering what we've been talking about just previously with those couple of dot points about interest rates still going up, a bit of the mixed data coming through. It's an interesting number.
Yeah, exactly right.
See where it goes.
Yeah, exactly. Next one's a little bit, you know, I mean, it's finance related because it does have an impact on the economy, but it's kind of just big news is the Supreme Court, their decision on the student loan forgiveness bills. Yeah,
so what this was is in the US, and like in Australia as well too, but a student coming out of, you know, university or college, it's funded by the government and it's crippling debt.
Yeah.
So if you think about starting your first full-time career, you're already starting behind the 8 ball because you've got some student loans. In America, those loans can get quite hefty, like they can in Australia as well too. So there was a proposal to be able to wipe that off, to try and forgive all of the debt for students, so they basically could start their first full-time career with a blank canvas, with a blank slate, without this debt baggage that they accrued throughout their studies. However, that was challenged, that decision, in the Supreme Court, and they rejected the proposal. So what was on the table to forgive all of that debt is now gone.
Yeah, which is kind of interesting. I mean, and what's likely to happen is that, you know, the Biden administration will just continue to defer payments and interest on a rolling basis, until more than likely another government, you know, comes in and has a different opinion, or, you know, all of this stuff is challenged once again. But the interesting part that I see in this is it's almost it's almost two players on the same team not going in the right or not going in the same direction. Yeah, you've got like the RBA is wanting to slow an economy down, and so they're increasing rates, stopping people spending money. And then on the flip side, you're talking about, student loan forgiveness, which is the completely separate, department. They're making different decisions, but student loan forgiveness has the opposite effect on an economy in that if you don't have student loans, if you feel like you can spend money because you're not needing to make repayments on student loans, then that's only going to fuel an economy and create greater inflation, which does mean that, the Reserve Bank needs to push harder on interest rates. So it's, a very, very interesting one. But obviously the decision by the Supreme Court does mean that it kind of halted in its tracks for at least a little bit.
Yeah, the other interesting point about that as well too is that what is the impact? Not necessarily today, but what's the impact in terms of that cohort and a generation of students going through? If you've got a generation of students going through that have this debt, their ability to be able to do things in the future, start businesses, employ people, be entrepreneurs, whatever it may be, is severely hampered because they're servicing that debt. So it's interesting. You've got paying the students paying for obviously their tuition fees, their college fees, and that's revenue in the eyes of the government or getting that money back. But then on the other hand, you might be forgoing something and you may not realise that for 5, 10, 15 years.
Yeah.
So that's a really interesting concept, and where that goes, who knows, and what impact that has, I don't even know if we can get some data around what that would look like, but I imagine that you'd be in a much better position. You'd be a lot more confident taking risks and making decisions and, feeling like, yes, you can open a business and you can employ people because you don't have that baggage behind you. So I just, thought I'd elaborate on that one a little bit, Andrew, because I find that that's really interesting and sort of throwback to what it is here in Australia. I mean, you look back one generation and university was free in Australia, where now...
I think in some instances you got paid to go to university as well. I know my dad did. He was actually paid to go back as a mature age student. But anyway, sorry.
There you go. Enough. But that's case in point, right? So, there's probably a debate there on another podcast around around the different generations, because I know that's one that's loves to get tossed around in terms of
which generation
who had it harder, or who had it easier. Definitely. Andrew, what's the next one? Maybe around wages and rent.
Yeah. So again, still over in the States, but there is a downward trajectory in wages and rents over in America. So it is potentially signs that interest rates are starting to peak. We're starting to see movements in the market and some indicators that it's having its desired effect. But the expectation is still that we're not quite at that end point yet. We're just starting to near that tipping point where we're likely to see interest rates increase slightly in the near term, and in the long term, we're probably not going to be seeing the same increase in rates, but we're starting to get to that point to that tipping point.
We're seeing the housing market still showing signs of resilience.
Still resilient in the States. I mean, we talk about people's love for property in Australia, but it seems like it's a worldwide love.
Yeah, and look, I don't know. I mean, look, I tend to come back to humans tend to think the same way regardless of where you are in the world. And I think regardless of your situation, just going back to your basic needs of, humanity, having a roof over your head is definitely up there around things like food security and things like that. So it's not overly surprising that that's the case. Their interest rates, their borrowing rates are different over there. They're on more fixed rates than what we are in Australia. So the interest rate lever doesn't impact the housing market as much over in the States as it does here in Australia. But no, look, it's good to see, because I think a strong property market and a strong housing market gives people confidence to go and make other decisions and deploy, their resources and take risks and things in the economy by employing people and starting businesses and the like.
Yeah, absolutely. Over to China. Some interesting data coming out of China, which is a little bit concerning, obviously, for Australia, but yeah, data in China is starting to create some concern over deflation. which is a little bit concerning in relation to, what that means for potentially avoiding recession, soft landings, all of that stuff. But it looks like the Chinese economy is starting to weaken and showing signs of weakening.
Yeah, and this is really interesting. I mean, everybody knows that China plays such a critical role in the world economy because they produce a lot of the world's goods.
Yeah.
The world's factory for a lot of countries, especially for us in Australia, not only from an import perspective, but also in terms of what we export to them as well. So if their economy's slowing, we're not exporting as much to them in terms of things like iron ore and raw materials and things like that. But this is a really interesting one because China's, I guess, response to COVID and in terms of how long they kept their country locked down for was a lot longer and a lot more stringent than, I guess, everywhere else that we saw in the world. Yeah. So this is interesting. Are we seeing that this is kind of the hangover effect of that?
Are they just 2 years behind where we are from, a financial market and economy perspective? Is this signs that the actual economy is slowing down, or is this just, exactly where we were at 2021 when we were coming out of lockdown and there was uncertainty?
Who knows? But either way, as part of the sort of worldwide economy, it's definitely worth taking note that China is in that position, and they're trying to make decisions on how they stimulate their economy. Where you've got, I guess, other countries like Australia, like the States, that are increasing interest rates because they want to slow their economies down. Yeah. So it's going to be really interesting to see how that plays out and how all of these things sort of mash together, and what this looks like over the next, I guess, 6 to 12 months is going to be a really interesting story to see how it plays out.
Yeah, absolutely. Absolutely.
Andrew, closer to home.
Closer to home. RBA kept rates on hold. I think there was a little, celebration from a big part of the population, namely the mortgage holders. But RBA kept rates on hold. Was only a few days ago since recording this podcast. But yes, interest rates were kept where they are. So that means that we've solidified, I think, from peak to trough, a 4% increase in rates. It was at 0.1% initially, and now it's at 4.1%. There are some signals and even commentary. I mean, when you sort of read the minutes from the RBA meeting, there is still commentary that they're monitoring things, that they're going to very likely increase rates in the future. Yep. But at this point in time, rates are currently sitting on hold.
Yeah, and I think it's good to see the Reserve Bank making decisions based on data. I mean, that's what you'd expect anyway.
Yeah, of course.
And I guess it gives us some hope and some light with this for mortgage holders predominantly, but for the rest of everybody participating in the economy, that if that's the decision, then maybe what we've done over the last 12 months has started to work or is working, and it's just a matter of waiting to see. So we've potentially done the heavy lifting, and now it's maybe just the tweaks around the outside. So because data is lagged, those decisions do take time to work their way through. It does take time, and you can't make those decisions with a full amount of confidence knowing exactly what's going to happen. But for the June decision, the fact that they have paused is a really good indication that what they've been doing is working. It's starting to show through the data, and hopefully that only leads to potentially, if we need it, 1 to 2 more rate increases if that's the case.
Yeah, and that's the expectation from economists, is that potentially a couple more interest rate increases over the course of what's left over in the year. But again, similar to the States, the expectation is that we're starting to reach that peak point of interest rates.
How does that impact unemployment, Andrew? What does that look like?
Yeah, I mean, look, unemployment seems to have bottomed. And what I'm talking about by bottomed is as unemployment goes down, it means that there are more people employed. And what we're starting to see is that's hit the bottom in terms of the unemployment rate. But it's not shifting the other way. So we're not seeing more people becoming unemployed, which yet exactly. However, and this is what's interesting about it is there was some commentary from the RBA governor, and he was talking about unemployment needs to actually shift in the other direction for it to have a meaningful impact on inflation, which is difficult for the everyday person, right? As more people become unemployed, obviously there's financial pressures associated with that. But the fact that unemployment hasn't started to shift the other way does mean that it's good for the everyday person, not so good for inflation. So we are likely to see inflation be a little bit stickier than what's expected, because when you've got a certainty of income, you're always going to be spending money, which is only going to fuel inflation. Whereas if unemployment started to shift in the other direction, that's when you are starting to see the indicators of, yes, inflation coming down, but also potential risk of recession and more hard times for more people. So it's it's kind of a double-edged sword when unemployment is so low in such a high inflationary environment.
Well, it's that balancing act that we've been talking about before. And look, in my mind, if you could do it slowly and bring inflation down while still bringing or maintaining unemployment and it not changing too much, that would be perfect. But just playing the devil's advocate here, I don't see how we do this without unemployment going up. I think that's just a function of it. And you hear a lot of businesses at the moment, they're struggling to get people. And what then tends to happen, which is inflationary in nature, is if your business needs people and you can't get them, you put the price up in terms of what you're paying people with their salaries and wages. And then as a result, your margins are squeezed. So what do? The goods and services that you're selling onto the consumer, you increase those, which is inflationary in nature. So it's this cycle of things, and the Reserve Bank are doing what they need to do in order to break that. So yeah, from my perspective, I think we might see unemployment start to tick up. And I think we're at that turning point, like we were describing before, with the data that's coming through. I think it's just a matter of time. So seeing the next round of data come through will definitely be an interesting one.
Yeah, exactly.
The local market?
Yeah, I mean, look, the S&P ASX 200 over the course of the month of June was up 0.64%. So again, we're seeing positive data from the share market, or positive reaction from the share market to all of the financial data that's coming out. Annualize the 0.64%. We're not actually looking at a bad rate of return. So it's again, you can't analyze 1 month's data and extrapolate that out, because that just doesn't work that smoothly. It'd be nice if
only it was that easy.
Yeah, exactly right. But again, positive news from financial markets, or financial markets are viewing all of the news as quite positive in nature. Great. Yeah.
Andrew, I think we nailed it. First time back, it's like riding a bike.
Exactly right. It's good. Got me back up to speed with financial markets and what's been happening as well.
See, signs of a true professional.
Exactly.
Huh? I like it. Well, Andrew, welcome back. To our listeners and our viewers, thank you once again for your time. Hope you got a fair bit out of today's podcast.
Yes, and please like and subscribe, because Pat is gunning for me in the background, so I need the subscribers to keep ticking up.
Awesome. Thanks, everyone, and we'll catch you on the next one.
Thanks very much.
Thanks for listening today. If you have any questions on what we've talked about, or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature, and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.